Good evening. It's Fred Oltarsh with Lieberman Futures. Tonight I'd like to discuss the options price sheet. Most of you are already receiving this by email on a nightly basis, and I want to make sure that you understand exactly what you're getting. And so I'm going to share with you exactly what we have on a nightly basis. The first sheet we're going to look at is the stats sheet, which is the bottom left-hand tab of your spreadsheet. And if you click on the stats sheet on a nightly basis, you'll see the following information, which includes the commodity, the last trade of the day, the net of the last trade of the day, the percentage change, the high, the low, the range on the day, and the dollar value range. Next, we see the 20-day average trading range and the 20-day dollar average trading range. This information is very important because it gives you an idea of the type of movement you can expect from that commodity and how much potential you have to risk, and then some from the way these commodities move. So if you look at the silver, for example, the average trading range in silver is almost $4,000 on a daily basis. On Friday, it moved around at $4,400 and $4,450. Next to that, we have the relative strength index, and that gives you an idea of whether something might be overbought or oversold, depending upon the number. The highest number, like silver at 92.83, is a very high number and looks like it can be an overbought situation. Some of the lower numbers, like the dollar index, may be oversold, dollar index, cotton, etc. So next to that, we have the settlement price of the at-the-money options in the various commodities, and that's always useful information as well. If we scroll up a little bit, we can see the next set of data, which includes open interest, volume, 10, 30, 60-day historical volatility, the change in volatility, the average implied volatility, and the 30 and 60-day differences between the average implied volatility and the 30 or 60-day historical volatility. These are really great for options traders who are trying to get a sense of where we're trading in comparison to the historical volatility. And each sheet next to it on the bottom will have that information as well. It also provides the skew of the markets, excuse me, and the settlement price of the at-the-money put. Finally, the last bit of information, oops, I went a little too far there, I think. Last bit of information provides information about the moving averages of each commodity. So, for example, we have coffee, gives you the last price, and then it starts to give you the 5, 10, 20, 30-day, 50-day, and 250-day moving averages. If the box is green, it means that the current price is over the moving average of that duration. So in coffee's case, it's above all those moving averages. In cotton's case, it's below the moving average for all those numbers except for the 250-day. Then after that, it compares the current price to the 50-day moving average and the percentage versus the 50-day moving average. So, for example, the current price in coffee is a 6.83 premium to the 50-day moving average. So 294.55 over 274.45 is a 20-cent premium, or a 6.83% premium. And we do that for all the commodities, excuse me, based on the 30 and based on the 50 and 250-day moving average. And it gives you an idea of just how the current market is trading compared to longer-term moving averages. Next, we're going to look at, for example, the corn options price sheet. Now, the corn options price sheet shows us, for example, we're looking at July corn options settled at $7.44.5. It's got the 10, the 30, and the 60-day implied volatility, not implied, historical volatility, and it shows us that there are 64 days left until expiration. Then every sheet that we have on this, all 10 commodities are structured the same way. We're going to have implied volatility change, vega, delta, the implied volatility of the particular option, the settlement price, and the strike for all the options. On the left side is going to be the call price. On the right side is going to be the puts price. So it's set up in a very standard way for all the commodities. One of the things you'll really want to notice is how the implied volatility changes. For example, there's a relatively small skew to the coal side here in the corn market. As we go further out in September, again, there's a relatively small skew to the call side. As you can see, the put skew is almost flat. Now, let's go to another market and take a look at how it works out. Go to S&P. The S&P, let me just move it down to, oops, I went the wrong way. Okay, S&P in the June settled at 1331. So if we move that to the middle, give you an idea of how the skew is. June settled at 1331, 10-day historical, 30-day historical, 60-day historical. It's 56 days till expiration. As you can see, the 1330 calls are worth 100 points more than the 1330 puts, 2970 versus 2870, which makes sense since we're trading 1331. The at-the-money strike has a 1405 implied volatility. As we go further out of the money on the put side, the implied volatility increases dramatically. As we go out of the money on the call side, the implied volatility gets less and less. These are the characteristics of the market in S&P. It has a significant call skew to the weaker side and a significant put skew to the more expensive side. And as you've seen from some of my articles or some of the descriptions of positions I recommend, you can create positions that have common sense characteristics and use that to benefit your particular market bias. So in my mind, the bigger the skew, the better the opportunity to put a position on that makes sense for you. Now, these positions can't be expected to take advantage of a market in a short period of time, but in a longer time frame, as the characteristics of the options take advantage of implied volatility differences, like things like decay that take place. So, for example, if you look, for example, at the let's say we look at the price of the, well, we're trading 1330. So we got the $1,400, 14 calls settled at 365, and the 14 puts settled at 920. Okay, that is a difference. No, let me try that again. 1330 and 90 is 1400. 1330 take away 90 is 1240, which I have to move up a notch to get there. So let's see if we can do that. Okay. So we want to have 1440 as our low point. 1240. Okay, now we're good. So we got 1330. We've got 1400, which is 70 points away, and 1260, which is 70 points away. So what you see there is the put is 1120 and the call is 365. That's a pretty dramatic difference in price considering that they're both 70 points away. Now, if you go over here in the maze, where there's much less time available, if you go 70 points away, the differential between prices has narrowed quite a bit, considering that the 1260 put is only 410 and the 1400 call is 60. So now it's a 350 difference, and over here it's a $685 difference. So by looking at this closely on a daily basis, you'll be able to structure positions that make sense based on your market bias. Let's take a look at one more before we sign off. I wanted to make sure, again, that you understand you're looking at the options month that you're looking at. the futures price associated with that, the 10, the 30, and the 60-day historical volatility, the days to expiration, the implied volatility change from the day before, the vega, the value of an option for a one-tick move in implied volatility, that's vega, the delta, the movement of the options compared to the movement of the underlying futures contract. You got the implied volatility of the particular option. You got the settlement price of that option. You got the strike that's associated with that option. And then you do it again for the put side. That's going to be the structure for everything. Let's take one more look at another market, and let's use coffee for that one. June coffee, well, let's look at July. July is more actively traded. We're trading 294.55, so the 295s are at the money. And again, I should probably move up a little. Okay. Sorry about that. We're going to move up. 295s. You can see that the puts, not much of a put skew really. It flattens out very quickly. And on the call side, when you go up from 295, there's a small skew. Not a big skew, just a small skew. But gives you an opportunity to look at potential positions. And again, using what's available to craft a position that makes sense to you. So what I would like you to do is I'd like you to look at this on a nightly basis. I'd like you to ask me questions. Call me. Feel free to call me and ask me any question that comes across your mind. And we can start to construct positions that make sense for you. This is the best way to improve your understanding, take limited risk positions, and see how they can work for you. If you feel that you're good on market bias, then there are tremendous opportunities available using options contracts where you don't have to risk too much to participate. And if you're got a pretty good market sense or you're not too much wrong, you can really do pretty well. So I think we're going to stop it there. I hope that you've enjoyed the webinar pertaining to information that you do get on a daily basis. And I look forward to hearing from you in the near future. Once again, it's Fred Oltarch for Lieberman Futures, and I look forward to speaking to you soon.